Ever wondered why so many traders swear by Fibonacci retracements and extensions in their technical analysis? Well, you're not alone. These tools have become a staple in the world of stock trading, and for good reason. The relevance of Fibonacci retracements and extensions can't be overstated. They provide traders a way to predict potential price levels that could be significant in determining whether to buy or sell a particular stock. Now, you might be wondering, what exactly are these Fibonacci retracements and extensions? They're tools based on the Fibonacci sequence, a fascinating mathematical concept found in nature. Yes, you heard that right, nature. This sequence, named after the Italian mathematician Leonardo Fibonacci, is a series of numbers in which each number is the sum of the two preceding ones. It starts off as 0, 1, 1, 2, 3, 5, and so on. But what does this have to do with stock trading? Well, the ratios derived from this sequence are eerily accurate in predicting the movement of stock prices. By applying these ratios to the price difference between a high and a low, traders can anticipate potential price levels. For example, the Fibonacci retracement levels of 23.6%, 38.2%, and 61.8% are commonly used in trading. Traders use these percentages to identify possible levels of support or resistance, which can help them make informed decisions about when to enter or exit a trade. And it's not just retracements. Fibonacci extensions, which are derived in a similar way, can predict potential profit targets or future price levels. But here's the catch. While Fibonacci tools can be incredibly useful, they're not a magic wand. They should be used in conjunction with other technical analysis tools for the best results. So, you see, the Fibonacci sequence isn't just a cool mathematical concept. It's a powerful tool in the world of stock trading, helping traders make sense of the often chaotic market movements. So, ready to delve into the world of Fibonacci and its application in stock trading? First, we need to understand Fibonacci retracements, but what are they exactly? Let's dive right in. Fibonacci retracements are a key tool in technical analysis, and they're based on the mathematical concept of the Fibonacci sequence. This sequence is a series of numbers where each number is the sum of the two preceding ones. The sequence starts with 0 and 1, and the third number is 1, the fourth is 2, and so on. Now let's bring this concept into the world of stock trading. In technical analysis, Fibonacci retracements are used to identify potential levels of price support or resistance. These are points on a price chart where the price of a security could potentially reverse direction. So, how do we identify these levels? That's where the Fibonacci retracement levels come in. These are horizontal lines drawn on a price chart at the Fibonacci levels of 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels represent potential reversal points based on the Fibonacci sequence. But here's the catch. To use Fibonacci retracements correctly, we need to identify significant high and low points on a price chart. These are the peaks and valleys. The high point is typically the most recent peak before a price drop, and the low point is the lowest level reached before the price starts to recover. By connecting the high and low points with the Fibonacci retracement tool, we can create those horizontal lines that represent potential reversal levels. These levels can give us clues about where the price might find support or resistance in the future. But remember, Fibonacci retracements are not a magic bullet. They are just one tool in a trader's toolkit, and they're most effective when used in conjunction with other technical analysis tools and indicators. Now that we've got the basics down, we can dig a little deeper into how to use Fibonacci retracements. How do you apply Fibonacci retracements to your trading strategy? It might seem intricate at first, but with a little practice, you'll find it's a powerful tool in your technical analysis arsenal. Let's dive in. To begin, we need to identify the high and low points on our price chart. This is crucial because these points will serve as our reference for drawing the Fibonacci retracement levels. Now remember, these high and low points are subjective. They depend on what time frame you're looking at. You might be looking at an hourly chart, or perhaps you're studying the daily, weekly, or monthly movements. The key thing is to identify the most significant peaks and troughs for your chosen time frame. Once we've pinpointed our high and low points, it's time to draw the Fibonacci retracement levels. This isn't as daunting as it sounds. Most trading platforms have a built-in Fibonacci tool. You simply select the tool, click on the high point, and drag the line down to the low point. And voila, your retracement levels magically appear on your chart. But what do these levels mean? Well, they represent potential support and resistance levels where the price might reverse. These levels are percentages based on the Fibonacci sequence, a sequence where each number is the sum of the two preceding ones. The most commonly used levels are the 23.6, 38.2, 50, 61.8, and 78.6% levels. Now here's a tip. Don't view these levels as exact price points where the market will definitely turn. Instead, think of them as zones of interest. When the price approaches one of these levels, pay close attention. Look for signs of reversal like candlestick patterns or other technical indicators confirming the reversal. Don't forget, Fibonacci retracements are a retrospective tool. They're based on past price action. This means they're best used in conjunction with other technical analysis methods to confirm or deny potential trading opportunities. So you've identified your high and low points, drawn your Fibonacci retracement levels, and you're watching the price action around these levels. You're well on your way to integrating Fibonacci retracements into your trading strategy. Here's one last piece of advice. Practice makes perfect. Start by applying Fibonacci retracements to historical price data. See how the price reacted when it approached these levels in the past. This will help you become more comfortable with the tool and give you a better understanding of how to use it effectively. Remember, retracements are just one part of the equation. Next, we'll explore Fibonacci extensions. This is where we'll delve into predicting potential price targets, but that's a story for another scene. Until then, keep practicing and happy trading. We've talked about retracements. Now let's shift gears and look at Fibonacci extensions. Fibonacci extensions are a fantastic tool in the world of technical analysis. They're like the adventurous cousin of Fibonacci retracements, always looking ahead, scouting out what's to come. While retracements help us understand where price might find support or resistance in the midst of a current trend, extensions are all about peering into the future. Think of them as your crystal ball, predicting potential levels of support or resistance that may come into play if and when the price continues to move in the direction of the trend. They're calculated by taking two extreme points on a price chart and dividing the vertical distance by key Fibonacci ratios. Now you might be wondering, what makes these extensions so special? Why are they worth my time? Well, here's the thing. These extensions can give you a heads up about potential price targets. They can alert you to areas where the price may start to slow down, stall, or even reverse. Let's say you're in a trending market and you're considering jumping in. If you've got your Fibonacci extension levels plotted out, you can see where the price might potentially head. This can provide crucial information about where to place your stop loss and take profit orders. But it's not just about spotting potential targets. It's also about managing risk. Understanding where these potential levels of resistance or support may lie can help you make more informed decisions about when to enter a trade, where to set your stop losses, and when it might be time to take profit. Just remember, though, Fibonacci extensions are not a standalone tool. They're best used in conjunction with other technical analysis tools and indicators. They're part of a wider strategy. And now, a question to ponder. Extensions give us potential targets, but how do you use them in your trading strategy? Time to put our Fibonacci extensions to work. Ready? Let's delve into the interesting world of Fibonacci extensions, an invaluable tool for any trader. It's like having a crystal ball that predicts potential price targets. However, it's essential to remember that these are not definitive predictions, but rather educated projections based on historical price movements. Firstly, we need to identify the swing high and swing low points on our price chart. These points are the peaks and troughs of a price movement. The swing high is the highest point reached before the price starts to fall, and the swing low is the lowest point before the price begins to rise again. These points are significant because they represent the full range of a price swing. Once we've identified these points, we're ready to draw our Fibonacci extension levels. Start by clicking on the swing low and dragging the tool to the swing high. If the price is on an uptrend, you want to draw from the swing low to the swing high. Conversely, for a downtrend, you'll draw from the swing high to the swing low. Next, we extend the line beyond the swing high point. This will automatically plot the Fibonacci extension levels onto your chart. These levels are typically 128.6%, 161.8%, and 200% of the original price range. They represent potential areas where the price could reach after retracing and then resuming its original trend. Now, you might be wondering, why these specific percentages? They are derived from the Fibonacci sequence, a series of numbers where each number is the sum of the two preceding ones. When you divide any number in the sequence by the number that follows it, you get approximately 61.8%, which inversely gives us 161.8%. The other levels are similarly derived. So, how do we use these extension levels? They can be especially useful in setting profit targets. For instance, if the price retraces to a Fibonacci retracement level and then starts moving in the original direction, we can use the extension levels to anticipate where the price might go. If the price reaches an extension level and shows signs of reversal, it might be a good time to take profits. Remember, the market is unpredictable and often influenced by factors beyond the scope of technical analysis. Therefore, Fibonacci extensions should be used in conjunction with other technical indicators for the best results. And there you have it, a step-by-step guide to using Fibonacci extensions. With practice, you'll find it easier to identify swing highs and lows, draw the extensions, and interpret the potential price targets. By now, you should have a good grasp of how to use Fibonacci retracements and extensions. Before we wrap up, let's go over some key points to remember about Fibonacci retracements and extensions. Firstly, Fibonacci retracements and extensions are crucial components of technical analysis. They are based on the Fibonacci sequence, a series of numbers in which each number is the sum of the two preceding ones. This sequence creates ratios that have been observed in everything from seashells to galaxies and, as we've seen, financial markets. Fibonacci retracements are used to identify potential reversal levels. These are points where the price could potentially bounce back after a significant move, either up or down. They are plotted by drawing a trend line between a significant high and a significant low, then dividing the vertical distance by key Fibonacci ratios: 23.6%, 38.2%, 50%, 61.8%, and 100%. Each of these levels represents a potential area where the price could retrace before continuing the original trend. On the other hand, Fibonacci extensions are used to forecast potential price targets or the end of a trend. They are calculated by taking two extreme points on a chart and dividing the vertical distance by key Fibonacci ratios. Unlike retracements, extensions project potential price levels beyond the current price, providing possible targets for breakout or trend trades. However, it's important to remember that Fibonacci retracements and extensions are not foolproof. They are based on the theory that markets tend to repeat themselves, but this is not always the case. Financial markets are affected by a wide range of factors, many of which are unpredictable. Therefore, while Fibonacci tools can provide valuable insights, they should not be used in isolation. This is where the importance of using Fibonacci tools in conjunction with other indicators comes in. By combining Fibonacci retracements and extensions with other technical analysis tools, such as trend lines, moving averages, or momentum indicators, you can increase the accuracy of your predictions and improve your trading strategy. It's also worth noting that the more times a price touches a Fibonacci level and reverses, the stronger that level is considered to be. So keep an eye out for these levels when analyzing your charts. Finally, always remember to use proper risk management. No matter how confident you are in your analysis, there's always a risk that the market will move against you. So always have a plan for managing your risk and never invest more than you can afford to lose. Remember, Fibonacci is a powerful tool in your trading arsenal, but it's not a magic bullet. Always use it wisely and in combination with other analysis techniques.